Hi, and welcome to the Stock Scores Market Minutes for March 28th, 2016. This week I want to talk about how we use price volatility to make profitable trades or good trades. So, first of all, what is price volatility? Well, when we talk about low price volatility, what I really mean is the range of price movement is diminishing over time. If you take a chart pattern and the gyrations in a chart, if you can draw a line across the tops and draw a line across the bottoms, and if those lines are converging, moving toward one another, then you have diminishing price volatility. When you get breaks from that diminishing price volatility, that is often an indication of a change in investor opinion about where that particular market is going to go. It could be that there's new information coming into the market or simply a shift in psychology. So what you want to watch for are the directional breaks out of low price volatility, because these tend to precede new price trends. And of course, as traders, we make money by getting in early on a new price trend. Now, the most common price patterns in technical analysis, when you talk about things like ascending and descending triangles and pennants and cup and handles and head and shoulders, all of those patterns are really about price volatility diminishing over time. So if you understand this concept, then you can trade it in any time frame. If you're a longer term trader taking your cues off of weekly charts, you can use that. If you're a very short term day trader, you can use it by focusing the concept on a 2-minute or 1-minute or 5-minute chart or whatever you like to trade. All right, let's get into a little example here. This is the chart of the VXX over the last 4 days, and I'm just going to highlight a few periods when there was diminishing price volatility. Now, the way I do that is just draw a line across the bottoms, draw a line across the tops, and if they're moving toward one another, you have diminishing price volatility. So anywhere that you can pick out highs and lows, that can be defined with a line, and when those highs and lows are converging toward one another, you have diminishing price volatility. So there's a whole bunch of them on there. These are different patterns. You have a pennant pattern here. You have a descending triangle pattern here, ascending triangle, pennant, pennant, descending triangle. Break leads to a downward trend. Break leads to a downward trend. Break up ultimately led to a downward trend. There was another break up. Break down led to a downward move. Break down led to a downward move. So you can see the importance of understanding low price volatility and really breaks from low price volatility, because they tend to telegraph new trends. I've done it here on a 5-minute chart. You go look at a weekly chart of some of the stocks you like to follow, and you can see this concept in play as well. All right, let's get into this week's analysis. S&P 500 30-day 60-minute chart, so relatively short time frame here. There's the upward trend line. There's the line that I would draw across the tops. Those lines are converging toward one another. So we had diminishing volatility, really very low volatility there. And on Thursday broke down out of that, and that telegraphed the start of the weakness that we had for the gap down on Friday morning. Market came back pretty impressively at the end of the day on Friday. So the buyers are not dead yet. They're still trying, but they did not break the little downward trend line that's starting to build. So I would say, pessimistic in the short term for the S&P 500. Longer term, I think it's still too early to call a major correction, but it does feel like the market is getting tired on the buy side. Here is the weekly chart, and you can now understand why the market would be tired. Simply put, the market has rallied up to the downward trend line that's been building over a number of months. So we've had, new highs here, and then a falling top, and now we're shaping up for another falling top. For the bulls to really maintain the long-term upward trend, we need to break through this trend line, break through that falling top, and then the buyers really have made a strong stand. For now, it looks to me more likely that we're going to see this roll over. However, it's very early in this process. I still think you can have a neutral outlook for the long-term picture of the S&P 500. But if we get more weakness next week and start to move down out of that, then I think we may retest those lows again. Here's a Russell 2000, very similar situation, downward trend line, a lot steeper on the Russell than it is on the large cap S&P 500. And it's not quite at the downward trend line yet, but it did show that weakness there. We could get a little rebound and move back up until we hit that, but we could also roll over here. So I think you want to be cautious with the small caps. You may get tricked for another week where the buyers push it up one more time, but it is pushing up against that downward trend line of resistance. Moving along to the TSX, again, short-term 30-day, 60-minute chart. Upward trend line was broken there. We've now built some falling tops, got a little head and shoulders top pattern building there. Again, very short-term. Broke down through the neckline. That was caused by strong US dollar, which meant weakness in gold, weakness in oil, and that started the selling pressure in the Canadian market. And we're now building that little downward trend line. So I think you want to be bearish short-term on the TSX. Longer term doesn't look so bad. You've got a downward trend line that was broken. That's step one in the process of reversal of a downward trend. Now what we need to do is build the rising bottom. This is our only low. We got a low here and we've just launched straight up off of it. What we need to see now is the market to pull back a little bit, build a rising bottom, and then break through that resistance from a rising bottom. It's got lots of work to do. That's going to take some time to play out. Short term, I think the TSX goes down to build that rising bottom, but long term, it does seem to be trying to build that basing and building in the lows. And so I think looking out, a year, we're probably higher, but looking out a couple of weeks, we're probably lower. TSX Venture didn't really see the selling pressure that the big TSX saw. It had a little bit of pressure there, but not considerable. These spec stocks are starting to gain interest. I think they will see a little bit of a pause here. They've been weak for a very long time. You've had an emotional bounce back, a considerable one. You think about that move from the lows. That's a big move, 470 to 580. That's better than 20-25%. So it would stand to reason that we'd see a little bit of a pullback here, build of a rising bottom, much like I talked about on the TSX. Treasuries, with that little bit of weakness in the market on Thursday, you see the treasuries start to attract capital again, money moving to safety, broke the little downward trend line, now pulling back. So it's really a mirror image of the S&P 500 chart in terms of breaking trend lines and starting to roll over. Keep in mind, if this is moving up, that means interest rates are moving down. So if you want to buy a house and you want to get a mortgage, that's a good thing, but it is a sign that there is increasing concern about where stocks are going to go. The comments out of Fed members like Bullard on Thursday, which really helped the market find some weakness, well, that is also giving some support to the US dollar, because the comments are that basically, yes, the Fed may raise interest rates as soon as April. Now, why are they saying this now? Well, because they can. They wouldn't say it a month ago when the market was in turmoil, but now that the market is stabilized, people feel a little safer to say, yeah, we may still raise interest rates. And that was really what took the market a little bit by surprise, although really it shouldn't, because that's been their stance all along. Well, now they're talking it up again, and that's what's given the strength to the US dollar, which has helped things like gold and oil find some weakness. So here is the this is the weekly chart of oil. So you can see we broke the downward trend. That's a positive. We've now had a little upward move there, pretty substantial upward move. And now we're breaking that. So likely we will see a pullback in gold. But the question is, does it move to new lows, or does it build a rising bottom and then bounce off of a rising bottom? At this point, I lean towards it moving lower in the short term. Longer term, I think it's too early to call. Given that it's broken the downward trend line, I do think that gold is on a process of stabilizing, a process of basing, but there's a lot of work to do there still. Similar situation with oil. This time I've taken the daily chart, not the weekly chart, and there you can see the downward trend line that was broken. We've talked about that. Nice little rally from a little head and shoulders bottom there. And now as the week came to a close, we had a little bit of weakness there. Again, rising interest rates, profit taking. I mean, people have seen a big move in oil. They're going to take some profits in the short term. I still think longer term oil is basing, but short term, don't be surprised if we get some volatility up and down, because it is in that period when it needs to see some profit taking. So the VIX showed a little bit of life. I traded that at the end of the week as it showed life again. And what I want to advise is that if the market does correct, this is the thing you want to trade. It's a great trader when the market is in a corrective mode. Is the market going to be in a corrective mode next week? I think it has a better chance than it did last week, but I still don't think it's a lock. And so you want to keep a close eye on how the market opens after the long weekend. So US stocks, I've dropped my rating in the short term to neutral. Long-term, also neutral. Canadian, I've dropped it to bearish from neutral. And gold and oil also dropping it from neutral to bearish, simply because we started to see some profit taking, some rolling over those short-term upward trends. The market is putting its focus back on the potential for an interest rate raise as soon as April. And that is causing some selling pressure to come in. We saw that Thursday and Friday. The chance for a pullback in all assets has increased, but it's still not considerable. I think that we need to see more weakness before we can really say the sky is falling yet again. I want you to be cautious on the buy side and begin to consider some of those bearish trades, because we do see that weakness coming in. So watch the VIX. Consider shorting stocks if we get more weakness. The real focus is going to be commodities in the US dollar. If oil moves down, it's going to drag the stock market down. If the Fed implies that rates are going to go up, you're going to see gold come down and the US dollar go up. So those are the things you want to keep a close eye on next week. Well, that has been the Stock Scores Market Minutes for, March 28th, 2016. Remember to follow me on Twitter. Remember to subscribe to this YouTube channel. Have a great week in the market and trade well.